Okay, we're talking about diversifying your portfolio today and why you're probably doing it wrong and a couple better ways that you could be doing it. All right, here's the thing. Most people diversify their portfolios and they're doing it all wrong, 100% wrong. You see, the traditional method of diversifying your portfolio, which is shoved down our throats everywhere you look, is to make sure that you spread your investments out over many different investments. Here's a problem with that. Many investments are actually correlated to each investment that you think you're diversifying from. I'll give you an example. If you have every account tends to have the S&P 500 in some form or another, okay? So if you look through your retirement accounts or anything like that, you're probably finding that something says S&P 500. Now that's a great product for growth. As the markets go up, as they have for the last 9 years in a row, you're seeing that position do really, really well. Well, another investment that is normally included in a traditional diversification model is the Russell 2000, okay? And I'll just go like this, all right? So here's two products already. Now you think, I took some of my money and I put it here, I took some of my money and put it here, and it's diversified. Well, in truth, it's really not diversified at all. These are both growth type products. For every one that the S&P 500 goes up, the Russell 2000 goes up about 0.95. Now, I'm just using a ratio here just to give an example, but if the S&P 500 is up 1, the Russell 2000 is essentially up 1 as well. Not all the time, but over the last 10 years, that's the correlation. So what do you think happens if the S&P 500 goes down 1? Well, this product here that you thought you were diversified in goes down as well, right? There's no other way to talk about it. Now, most portfolios do not only have two investments. You typically have a couple different mutual funds, maybe some exchange traded funds in there as well. One of the investments that is typical, especially with the automated investing services, is the emerging markets. And I'll just keep it short, emerging markets, okay? Now the emerging markets, you think, okay, great, I'm investing outside the US. Well, in the emerging markets, that typically goes up 0.82. So not as correlated to the S&P 500, but we have a very positive portfolio here. If the markets continue higher, your Russell's going up and your emerging markets will lag behind just a little bit, but not by much. So if you have these three investments in your portfolio, which I promise in one way or another, you have these in there, you're not diversified. And you don't care right now because the markets are just going straight up. So all of this looks really, really good. Now, if the S&P starts to fall, sure, this one won't fall as much, but you're not diversified. You're going to be losing money against all three of these positions. Now, another investment that people have is gold. Gold is actually quite popular. It's not really appreciating in value much right now, but gold is a popular hedge. That's kind of how they determine that. Now, this is a diversified investment. This gold is not correlated to the S&P 500. In fact, for every one that the S&P 500 goes up, gold is only up a fraction, a minor, minuscule little fraction. So what does that tell you? This is going to lag back in your portfolio. Let the markets go higher. All of this will move higher. Gold should be just dragging, maybe going sideways. You don't even notice any gains in that. That's okay. Having stuff like this helps you when the markets fall, because while the correlation is still positive at the moment, it won't stay that way. What happens with gold is as the markets fall, if they ever fall again, people get nervous and they start selling some of this, realizing they're not diversified, and they move some of that money to gold. Well, gold ends up moving in the opposite direction of the market. So this correlation eventually changes to be negative. I don't mean to be all geeky here, I'm just trying to show you the specifics. So what can we do? Let's assume that you have this and you have some bonds, okay? And bonds tend to have a negative correlation. I don't know exactly what it is right now, I didn't plug it in, but bonds tend to move in the opposite direction of your growth portion of your portfolio. This is also a form of a hedge. So if you have some sort of mix of these investments right now, what can you do? I'm going to reference Warren Buffett for a second. This guy is out there all the time saying you should be diversified, you should be in index funds, diversify across index funds, and then just hold them forever. All right, I sort of agree there, okay? The problem is that's not what he does. He doesn't do anything near that. In fact, he's not even diversified in the traditional sense. He makes heavy, heavy bets in, say, Coca-Cola. He makes large bets in Bank of America, real estate, things like that. Now that's okay because he's using a different strategy. Each one of his investments has a different strategy or a different goal. Now, if you're going to diversify your portfolio by product, then this isn't going to cut it, okay? We need to diversify a different way. There's a lot of things we can do. If you're going to diversify by strategy, now this starts to make sense. And I'm not suggesting that this is the portfolio for you. I'm just saying if we have different strategies for each one of these, now we can make some sense of this. Where would we start? Assuming you had this portfolio, the first thing that sticks out here is that gold is not doing anything. Whether the markets go up a little or down a little, gold is barely moving. So what can we do about that? We can rent that out. If you've seen some of our other videos on renting your investments, this would be a prime candidate to treat this like a house. Okay? And I'm not going to go into detail too much. We have great videos on this on our YouTube channel, also on jazzwealth.com. While you have these products that are not moving, they're not correlated, let's change the strategy here. Rather than hold it and just hope for the best, let's rent this investment out. We can get people to pay you money each month. I know it sounds a little silly, but it's just a way that I kind of take a complicated scenario and apply it to something we all understand. We all get real estate. You buy a house, you rent it out. You buy another house, you rent it out. Some houses, however, you might want to flip. Some houses you may never ever want to sell. You're going to hold forever. And some houses you may rent out. A good example is going to be Warren Buffett and exactly what he does right now. He has a large bet in Coca-Cola, and he's had it for years. He's on record saying, I will never, ever sell that position. That's his strategy. He's never going to sell it. Good times or bad times, he believes Coca-Cola will do great forever. And so his bet on that company is sizable. I mean, it's large. Look it up. It's very impressive. A lot of zeros, basically. But then he had an investment in Bank of America. And when he started that investment back in 2009, somewhere in there, 2010, he flat out said, this is a different strategy. I'm going to use a different approach to this in hopes of making a big score in the short term. Now, to be fair, his short term is like tens of years, right? He thinks in lifetimes. So if he says a short-term play, he probably means 10 years, 15 years, something like that. Well, his Bank of America play worked out great. Go back and look and see how he converted shares of Bank of America. Unbelievable, very smart play. It was very risky at the time, but he had a lifetime. He was willing to make that bet. So again, he had two different strategies. And compared to the other positions in his portfolio, same thing. He has different strategies on everything. Why should we build a portfolio that we think is diversified and then just hold it forever? Why can't we have different strategies on our positions? Well, you can. You just have to have the right person to do it. So at Jazz Wealth, we'll take a look at your portfolio and say, look, the markets are up 9 years, right? This is a historic rally that will be studied by our kids and grandkids, I guarantee it. So what we do is we say, this is going well. Let's not disrupt what's going well. Let's try to improve upon it. Let's take things that we're currently not using or seeing any real growth out of and rent them out, make our money that way. That makes it so that if this starts to fall, then we have some rental income in there as well. That's what makes us different. We have a very unique approach to doing that. If you'd like to learn more about renting your portfolio or renting your IRA, on our website, jazzwealth.com, we do a lot of great videos on there that go into specifics, great detail about how we would go about doing this. And if I can help you or you want to transfer your retirement account to Jazz Wealth, go to the top, click schedule a call. Let's talk about it and see if it makes sense for you. One of the things you'll know about us is that we never ever take your money. So if you have a retirement account somewhere and that money is at a big investment group or a big investment bank, they have your money. If you move it to Jazz Wealth, you hold the money. We just go to work and try to grow your retirement. So big difference there. You never have to wonder where your money's at because you always have control over it. So if you want to talk or learn more, just go to the top of our website, click schedule a call, and hope to talk to you soon.